We continue our discussion on tax implications coming out of the 2012 budget as presented by Minister Pravin Gordhan. In studio, we have Rob Stretch, Director at Ernst Young, and Andrew Wellsted, Head of Tax at Norton Rose, South Africa. Very warm welcome again, gentlemen. It's our third round now. You wanted to ask something to the Commissioner, and we'd run out of time. You had to run. But one of the things you wanted to say is we do need to move in terms of getting away from the old ways of the way that we tax and moving into modern times.
Yes, and I would like to ask the Commissioner, there's been a lot of talk over the last few years about updating and revamping the whole Income Tax Act. There are sections of the Income Tax Act that are designed to tax certain transactions in a way, but they are antiquated in comparison to the way transactions are carried out nowadays. And they have alluded to it in the budget in terms of looking at your financial instruments, where for normal accounting purposes under your IFRS and so on, they're accounted for on a mark-to-market basis, whereas the Income Tax Act, your old Section 24R doing with your foreign currency transactions and so on, is antiquated. It's just not the way things are accounted for anymore. So, as they made mention, it becomes very difficult for them to police it, but they need to update the Act to take into account the modern way of doing things.
I wanted to talk a little bit about some of the things that do come up. One of the things that came up last year was the Section 45, and that seemed to put a spanner in the works. Rob, you're having a bit of a chuckle there. What happened? And that did seem to put a spanner in the works when it came to, we didn't hear it in the national budget, but it did come on later on in the year. And from the practitioner I was talking to, he was saying that it put large deals on hold for the economy. So when we do get such things that do get announced later on, not part of the national budget, I would imagine that it does give some kind of shock to business.
Yes, and I think that did come as a shock last year. I think it was 1st of July they made this announcement that has simply been withdrawn with immediate effect. And when you ask them why the sudden urgency, they keep on mentioning a transaction that was done 4 years ago. Well, why has it taken them 4 years to actually put a stop to it? So I think it was a bit of a knee-jerk reaction. They did go back on what they had originally said and lessen the burden to a certain extent, but I think it's a much bigger issue. It's not just a once-off Section 45 transactions. And as we've seen in this year's budget proposals, they're looking at the whole issue of the deductibility of interest, linked in with the interest withholding tax coming in, linked in with the changes in what is termed thin capitalisation rules that become effective on 1st of April. So it's a much bigger picture. So I think last year's reaction was a bit of a knee-jerk reaction, and yes, it probably did stop a number of transactions that were about to happen.
Andrew, I want to come to you when it comes to one of the comments that I heard quite a lot in the previous interview that we had when we were at post-budget was this issue of, well, there's so much money that government wants to spend, where is it going to come from? And when I asked you in the break, both of you nodded, you're also concerned about that.
No, we are. Look, and I think the increase in capital gains tax rates and the increase in the dividend withholding tax rate, which is going to be introduced in April, they've increased the rate on the interest withholding tax and the royalty withholding tax. So there were some of the non-star taxes that people don't talk about often. We've had rate increases in the background. So there are increases in rates. I also think that we may be looking at specific taxes to address specific things. The NHI, we know better informed than we were last year, for example. We know the NHI is going to be expensive. We know it needs funding. We know that there's job creation and there's infrastructure development that's high on the government's agenda. So in this year's budget, again, it was said they're looking at a VAT increase. They're looking at perhaps a payroll tax, something along those lines, but nothing committal. And we're probably going to be wondering next year the same thing. As I say, this year we do have some tax rates increase, none of the big hitters, not income tax, not VAT, nothing like that. But there are so many projects underway that are expensive, and that is one thing that I think concerns taxpayers and practitioners alike.
One of the things that I found pre-budget, there seemed to be a lot of negative sentiment. What's going to come out of this budget? We had this super money tax. We had this, are the wealthy going to be really taxed? What's going to come out of this new budget? And then after it, we also spoke to business people after the budget who were saying that we didn't get so many shocks. It was actually a good budget. What was your sense from a tax perspective? What was your sense of it?
I think one needs to be a little bit realistic with it and saying that South Africa is now becoming a very expensive place to do business. And I'm afraid I think it's going to have a negative impact on foreign investment into South Africa. We've already seen it with major mining companies globally that are not actually making any further investment in South Africa because while there's this nationalisation on the table and super taxes and so on, they're not prepared to look at it. But normal businesses, because if we are looking at an infrastructural development to the extent that they are talking about, a lot of it's going to be funded through user charges, which is going to come down to the individuals and the businesses. So, why should foreign companies invest in a country that is very expensive in terms of not only regulations, but in terms of additional taxes? And just yesterday I was reading in the paper, they were talking about, as far as Africa goes, Nigeria and Egypt becoming more competitive than South Africa.
One of the things I was talking about in earlier interviews today when we had Power Lunch, one of the comments that came out yesterday was from this air freight now that has happened between China and Kenya, and KLM coming out and saying, well, Nairobi, they're seeing it more and more becoming this gateway to the rest of the African continent. So we are seeing this where you're having hugely competitive emerging markets with South Africa. But I'd like you to comment from a corporate tax point of view. Are we still in line with other economies, particularly emerging economies that seem to be taking a lot of focus right now, considering what's happening with more developed economies?
Look, I think everyone's holding their breath, seeing what happens in the world economies, and we can see it in Europe. Tax rates are increasing. The taxpayer is going to bear the burden of a lot of what's going on. But Rob's correct. We are trying to position ourselves as the gateway to Africa. We need to be business friendly. Now, contrary to what the Commissioner said, I don't know if Rob will agree, but I know a number of tax practitioners and none of them feel that things are becoming more simple. Things are becoming more complex, and I think there are a number of instances that we can point to in this budget where they're looking at tax changes and implementing new taxes that are not going to be easier and they're not going to be more complex. They're all around avoidance. So I think that if we are serious about making South Africa a competitive place and somewhere where investors want to invest into as a viaduct into Africa, we need to think about deregulation, making tax simpler and making it easier and less expensive to do business.